Good afternoon, everyone. Welcome to this afternoon's virtual pre-retirement seminar. I'm Jeff Papst, Loggers Education and Outreach Coordinator. And today we're going to spend about an hour and a half, maybe 2 hours, depending on questions and conversations that we have, discussing and giving you some information regarding the process you're about to go through. So you're getting ready to, or thinking about it, or considering it, or maybe you're even on the periphery of thinking about drawing a benefit from loggers. So what this webinar is designed to do is to kind of get into the details about your benefit, how it works, the process you need to go through to apply, your options. Then we'll talk about a little bit about taxes and cost of living adjustments and a few other things. And then we'll be done. So first, there's a couple housekeeping items. Agenda today, like I said, we might go an hour and a half, 2 hours, all depended. The other piece of housekeeping that we need to take care of today is, how do you ask me a question? So there isn't really a dialogue line for you to ask a question. You can, if you want, raise your hand and I can give you access to audio, but you have to have had a microphone on your laptop. But if you have that capability and you'd like to speak through the webinar, you can do that. You just have to raise your hand and ask to be unmuted. Otherwise, if you'd rather just type in questions, the way to do that is when you logged into the webinar today, there was a dialog box that appeared on the screen. So it's usually at the bottom for the attendees of a meeting. It might be at the top, just depending on your user preferences. But when you scroll to that dialog box that disappears when you move your cursor off of it, there's a section in there that's called Q&A. So the Q&A is open on my screen. So as you're asking questions, I'm going to see them come in. And then I will do my best to respond to them as they come in, and give you an answer directly to the question that you may have at that time. So don't hold off and wait till the end to ask the questions. If you have a question, type it in, I'll answer it. And even if it's not necessarily directly related to what we're talking about at that moment, I am happy to answer any question that you have when you ask it. So let's get right into the session. So first thing we want to talk about a little bit here, and we're going to keep this pretty high level and move pretty quickly through this first little section here, is we want to discuss how your benefits are calculated. So Loggers is a statewide public pension plan. We were created by the General Assembly in 1967 to provide disability and survivor and retirement defined benefit plans to local government subdivisions in Missouri. Being a defined benefit plan, that means that there's a formula that you can use to calculate the amount that you could expect from loggers every month. Okay. This formula goes as follows. We take a benefit multiplier. This is an employer elected percentage that ranges between 1 and 2.5%. If you participate in Social Security, the highest multiplier available for you is 2%. If you or your department doesn't participate in Social Security, then you can opt for and by you, I don't mean individually, I mean the subdivision itself, or the department that you are employed by doesn't participate in Social Security, then they have the option to adopt what's called our L11 plan, which has a 2.5% multiplier. So generally speaking, 2% for most of you is the highest you can go. So we take that multiplier times how much you make. We call this final average salary. This is either the highest consecutive 36 months or the highest consecutive 60 months of salary from your, highest consecutive 36, highest consecutive 60 months from your last 120 months of loggers credited service. Whether it's a 60 or a 36 is dependent on what your employer has elected. So we take a multiplier times an average monthly salary times how long you work. We call this service credit. So multiplier times salary times service credit gives you a monthly benefit that's payable for life. So that service credit accrues in our system every month you work. It's not whole years. Every single month you work, you're getting an additional service credit within our system. Okay. If you had a 1.5% multiplier and a $3,000 average salary at the time of retirement, and you had 25 years of service credit when you left employment, you would be eligible for $1,125 per month for the remainder of your life. And how we did that was we took 0.015 in our calculator times $3,000 a month times 25 years, and that gives us the $1,125 per month. That number is what we're going to use as we go through all of the payment options in our screens to follow. Okay. Average salary. So I talked about this generally. I wanted to give you an illustration here. So when we calculate final average salary, we look back 120 months from your retirement effective date, whatever that date may be. And then from that 120 month window, we will take the highest consecutive 60, which is in the green, or the highest consecutive 36 months, which is in the blue. Okay. And we'll average them out and we'll plug those into that second component of the formula. Okay. So in this case, in this example, you're actually seeing, doesn't always happen this way. Most of the time, your average salary falls in your last 5 or your last 3, right? Because that's what I hear a lot out in the field is our members are like, it's the last 3, the last 5. It's like, most of the time, the answer to that would be yes. But the way it technically works is it's the highest 5 or the highest consecutive 3 from your last 10 years of credited service. Okay. But again, everything Loggers is doing is by month. Okay. So in this case, it's all of 14 through all of 2018. It's that highest consecutive 60 months. And then it's all of 2016 through all of 2018 for that highest consecutive 36-month average. Okay. So, and the other thing that this kind of illustrates as well is if you're wanting to maybe take a step back from whatever level of position you have, maybe you're in a little bit more of a leadership role and you kind of want to step off of the leadership role, but you're not ready to retire yet. But you kind of want to ease your way in and not have to supervise folks and have the other larger responsibilities that maybe that higher level position may have had. That's kind of what this is illustrating. It's showing someone who took a lower paying job in 2019 and 2020. But that lower paying job didn't necessarily have a negative impact on a person's final average salary because they didn't work for too long in that lower paying job. So if you're thinking about easing your way into retirement and you want to step down into a lower paying job, but not ready to retire yet, if you have a 5-year average and you don't want to have it impact your average salary in any way, then you don't want to do that lower paying job for more than 5 years. If you have a 3-year average, you don't want to do it for more than 7. Okay. So a couple things, and I thought there was a slide that followed this, but that's fine. We'll cover it really quick. So what's included in your average salary? So what's included for average salary purposes is your gross wages. So it's what you were paid without anything taken out. It includes any elective deferrals. So if you're paying for health insurance out of your paycheck, if you're paying into a retirement savings account, like a 457 plan, out of your paycheck, that's included. Okay. It includes overtime and recurring bonuses. So if you've worked overtime, or if you have a recurring bonus that whether it's a performance bonus or if it's a holiday bonus or any kind of recurring payment of a bonus in a bonus form would be included. Any sick and vacation buyback program where your employer doesn't allow you to maybe bank as many hours of sick leave or vacation leave, but since you didn't use it, they compensate you for it on a recurring basis. That can be annually, quarterly, monthly, whatever it is. That would be included. That compensation for that sick leave would be included. And then any allowances. So if you've got a uniform allowance or a cell phone allowance that's being paid to you through your paycheck on a recurring basis, that's going to be included for your final average salary purposes. The one thing that's not going to be included is the payment of leave at the end. Okay, so when someone terminates employment or leaves employment, whatever you want to call it, and the employer pays out all of their leave in their last paycheck that they had banked, okay, that one-time payment for all that leave that they may have had accrued is not reportable for Loggers purposes and therefore not included in your average salary. Okay. Okay, so working for more than one subdivision, I think we have one or two folks that may be in that boat on the seminar today. So let's go through it really quickly. So the way Loggers works is we have 840 40 plus subdivisions across Missouri, and all of them elect their own level of benefits. So, one employer might have a 1.25% program like this one, and then another one might have a 2% or a 1.75 or whatever it may be. So because of all of those different elections that they have and that their cost is related directly to their group, the way that the calculations are done for multiple employers, in your case as a member, is we're going to do them separately. We're basically going to calculate one benefit for one stint of service and then another benefit for the other stint of service, and we're going to add them together and pay one benefit. Okay, so here's an example of that. You work for an employer that had the L3 1.25% program with a 3-year average salary. Started there in 1990, left employment, and went to another loggers employer in 2015. You work there for another 5 years and then you retire. That new employer that you moved to had a higher benefit multiplier of a 1.5%, but a lower final average salary with the 5-year final average salary. Okay, so here's how that math is going to work out for you. We're going to do one calculation for your service credit that you had at the 1.25% employer, and that times an average salary times the 25 years you worked there. That gives that 955.63 on the screen. And then we're going to do another calculation for the 5 years that you worked at the separate other employer. And that's the 1.5% times the average salary times 5 years of service. And that gives you the $222.23. We're going to add those two benefits together and pay them in one benefit. Okay. The one component that's the election is separated out, but the data that we're using isn't, is the average salary. So when we calculate final average salary, the law dictates that it must be from retirement date back 120 months. So that's the data window for your salaries that we're going to be using, is 120 months from retirement date. So in this case, you could have potentially taken well, basically what happens there is the reason that you're seeing a difference in the final average salary here is because the 1.5% employer had a 5-year average, which typically yields a lower average salary. And the 1.25% program had a 3-year average, which typically yields a higher average salary. But we were using that same 120-month window from retirement date back 10 years. Okay. So keep that in mind, that maybe your salaries, if you worked somewhere a long time ago, maybe it's 10, 15, 20 years ago, the salaries that you're earning now may be having an impact on that benefit that you worked at a different employer 10, 15, 20 years ago. Okay. Eligibility. So there's 2 hurdles to eligibility with the logger system. The first is vesting. Vesting is a term that was created by the pension industry, or finance industry primarily. That means guaranteed to receive payment. Okay. I like to say guaranteed to get paid. So once you're vested upon 60 months of service, you're guaranteed to receive a benefit from loggers, even if you terminate employment, go work elsewhere, and never return to covered employment again. So 60 months or 5 years is the vested point in our system. The next step to eligibility is reaching a retirement age. Okay, so retirement ages in the logger system for normal retirement is age 60 for general employees, age 55 for police officers and firefighters. In addition, if your employer has added a public safety department, this is for EMS personnel, jailers, and dispatchers. If they have added that department, which is a new addition that your employer may be eligible for, first passed in 2018. This year we passed it where all eligible subdivisions can now do this if they'd like. But for the EMS personnel, dispatchers, and jailers, that the employer has added a public safety department, their retirement age is the age of 55. If you are an EMS personnel, a dispatcher, or a jailer, and dispatcher or a jailer, and your employer hasn't added a public safety department, those classifications of employees reside in the general department and have an age 60 retirement. Okay, so general age 60, 55 for police officers and firefighters, and 55 for public safety where the employer has chosen to do so. You can also retire up to 5 years earlier than your normal retirement age. So if you don't have the rule of 80, which we're going to talk about, but if you don't have an early retirement the early retirement provision, you do have the option to draw a benefit as early as the age of 55 as a general employee and 50 as a police officer, firefighter, and public safety where applicable. Okay, so you do have that option. However, if you take a reduced benefit with an employer if you take an early benefit with an employer that has normal retirement, it will be reduced. Okay, so it's reduced by 0.5% for every month that you are younger than 60 or 55, whichever group you're in. That's 6% per year that you are younger than 60 or 55. If you go, and the earliest you can go is 5 years early. So if you take the earliest, it's a 30% reduction to benefit. Now I've said reduction like, I don't know, 5 times so far. And what you've probably heard instead of reduction was penalty, because that's what every time I say that, everybody's nodding at me like, yeah, that's what you said. I didn't say penalty, I said reduction. And the reason I say reduction and not penalty is because the value of your benefit, if you're a general employee at the age of 55 with 25 years of service and you choose to terminate employment, okay, you can take that benefit at age 55 with a 30% reduction, or you can not take it at 55, wait till 60 and draw it with no reduction, okay? But that reduction is designed so that if you aren't earning service credit, so that same 25-year benefit, that reduction is designed so that if you draw it at 55 versus wait till 60 with no reduction, that by the time you pass away, regardless of which of those options you choose, you will have received the same dollars from loggers in total. So what we're trying to do is take the value of your benefit that you have earned up to that point, and if you're taking reduction, we're spreading it over a longer period of time. Okay. If you're not taking reduction, if you're going at 60, there's no reduction. Okay. So what the reduction is designed to do is essentially spread out the value of your benefit over a longer period of time, because you're receiving payments earlier than expected. Okay. That's generally how that works. Okay. Rule of 80. So the rule of 80 allows for employees to retire earlier than 60 or 55, whichever your age group is or department you're in, but allows folks to retire earlier than 60 or 55 when the sum of their age and service credit equals 80. So a person who starts at the age of 20 and they work 30 years, they're age 50. Okay. That 30 years of service credit plus their age of 50 equals 80. That person can retire with no reduction to benefit at the age of 50 if they choose. It's not required. It's just that's the age when they can. And anywhere in between, these are just examples. So if you started at 22, then it might be 51. I'm not real sure. I haven't done the math in my head, but or if you started at the age of 25, then it's 52 and a half. Like in my case, I started at I think I was 23 and 9 months, something like that when I started at Loggers. And so my rule of 80 age is 51 and 6 months or something like that. So it's all based on your age and service credit at the point at which it will equal 80 is when you can draw a benefit early. Okay. Rule of 80 applies to, so rule of 80 only applies if you work up to or beyond your rule of 80 age. If you terminate your service with your rule of 80 subdivision prior to that, and you never return to covered employment again, then your retirement age is 60 for general and 55 for police, fire, and public safety where applicable. So the only way you get the rule of 80 is if you work up to your rule of 80 date or beyond it. Okay. As well, if you were a police officer, firefighter, and public safety where applicable. So if you worked in one of those departments and you started in that department at the age of 30 or older, or a general employee at the age of 40 or older, rule of 80 doesn't allow you to draw your benefit any earlier. So if your employer has the rule of 80 and you're you started at 30 or older in police, fire, or public safety, or 40 or older as a general employee, your retirement ages are normal retirement of age 64 for general and 55 for police, fire, and public safety. Okay. So that's pretty much it on the benefits side of things, on eligibility, on average salary. If you have any questions, again, how do you ask those questions? You can choose to raise your hand. I will see when your hand goes up. I can give you access to speak if you'd like, or if you're a bit more comfortable just doing Q&A and typing it in, that's just fine too. So what you'll want to do is go to your dialog box, scroll down that dialog box, find the button that says Q&A, click on it, type in your questions. I'll see them come in as they come in, and then answer them as well. So when they come in, I will answer them. So feel free to ask those questions. That's the whole reason you're here today. Sorry, I clicked my slide. That's the whole reason you're here today, is by the time you leave here, hopefully you don't have too many lingering questions, and that you're a bit more comfortable with the process you are considering going through in the next, year to 5 or 10 years. Okay. So now we're going to get into a much more of the meat and potatoes. So we're going to talk about application process, and then we're going to talk about payment options, and then we're going to get into some after retirement topics. So buckle up. We're getting ready to go into the deep stuff. Okay. So when and how to apply. Loggers must receive your application no less than 30 to 90 days before your first desired benefit payment. Okay. So a minimum of 30 days is the minimum notice. 90 is the maximum. If you send it in more than 90 days in advance, we'll actually send it back to you and say, sorry, we can't process it until 90 days prior to. Okay, you can complete the application in one of two ways. You can use a paper application. You can download it from our website. You could probably get it from your HR department if you have one, or city clerk if you have, or your clerk or someone in the administration of your subdivision can probably get it for you. As well, the digital booklet that was sent to you with your benefit estimate. One of the last pages in that booklet has a paper application that you can print out, fill out, and send in. Or you can apply online through MyLoggers. So when you apply online through MyLoggers, it's basically taking the application that you can do via paper and breaking it into like 5 steps. It's asking you some questions like, when's your last day of employment? When's your first benefit payment? Ask things like your date of birth, number of other things, beneficiary information, a few things that are all kind of filled out, but it's step by step. A little bit easier to digest online, but we understand that some of our membership just isn't going to be comfortable with doing things online. So the paper application is still available. Okay, so you can do it one of two ways, but at a minimum 30 to 90 days. Okay, also documents you need to be gathering. You need to gather your birth certificate, okay, because you're going to need to send a photocopy of that with your application. If you send it online, we'll reach out to you with a secure way to send it back to us. And then if you do it via the paper form, just send a photocopy with the paper form. In addition, we're also going to ask for your spouse's birth certificate and marriage certificate. If you're assuming you're married, okay, you want to send all of that in with the application so that we can properly calculate out your payment options. Even if you don't plan to provide for a spouse, you may be married, but you don't plan to provide for them. That's fine. We'd still like to be able to provide you with all of the options so that you fully understand what choices you have in front of you. So make sure that you, if you don't know where your birth certificate or your marriage certificate is, if it's safe deposit box, or you don't really have a copy and you need to work on getting another copy from your health department or the county, make sure that you start doing that now, and start doing it before you begin the actual application process, because not so much that it's that big of a deal. It's just less stress for you, because then you're not waiting on someone else to generate this document that you need to complete this application and get it on time. Instead, you've got it on hand. So then when you're ready to pull the trigger on applying, you've got all the information that you need. Okay. All right. Got a question here. Michael says, if you choose the partial lump sum, why can you not split that amount and put a portion into another retirement account like a 457 plan and keep some of it? That has a little bit to do with some of the IRS rules there. But there's a way to accomplish what you're trying to accomplish, Michael. So what you're trying to accomplish is just an example. Maybe it's your example, maybe it's not. But say you have a little bit left on your mortgage, and that little bit is less than what you're going to get in your partial lump sum. So you're like, okay, well, I don't need the whole partial lump sum, but I need, say my lump sum's like 60,000, but I need 20 of it to pay off this debt. But I don't want to take all 40 and pay the tax hit on all of it, right? So the way to get there, to accomplish that, is to do a rollover of the full amount and then withdraw it from the account that you rolled it into. Okay, that has a lot to do with distribution rules and some tax rules there. There's no way for us, as far as the law is concerned, the partial lump sum, it's an all or a none sort of deal. So you got to, if you pick it, you're getting the amount that it is, but your options for what to do with it are dictated a little bit by the IRS code. And what happens there is just because of that IRS code, the best way to accomplish getting a portion of the lump sum instead of all of it is do the direct rollover. That way you get the full amount. You're not paying taxes on the full amount. And then all you're doing is withdrawing the amount that you need from that 457 plan. And then when you withdraw what you need from that, you're paying taxes only on the amount that you need and not the full lump sum amount. Okay. So that's kind of a way to get there, to kind of accomplish what it sounds like you're trying to accomplish, Michael. If that answered your question, great. If you have further questions, keep on typing them in. So Shannon, who do you work for? Shannon just asked a couple questions about public safety or the rule of 80. Your employer should know. That's the first thing. But I can probably tell you off the top of my head, maybe not off the top of my head, Jasper County Sheriff's Office. So Jasper County has not added a public safety department as of right now. I do not believe that they have the rule of 80, but I'll need to double check on that. But your employer should know. They should be able to tell you what your benefit elections are. If you'd rather not go ask them, then you can go to our website. We have under the member drop down, there's at the bottom, it's called member employer listing, and you can search for your employer and it tells you exactly what benefit options you have. But I know for a fact that they haven't added a public safety personnel. We've only had about 7 or 8 that have actually done it up to this point. And that's because the law prior to that was limited to only class 3 counties. And then during the last session went into effect August 28th of this year is when it opened to all county classifications. And Jasper is not a class 3. They're higher than a class 3. I think they're a class 2, I think, or a class 4. I can't remember, but they aren't a class 3 from my understanding. So either way, regardless, I know they haven't added it. And if you want to know if you have a rule of 80, go check on our website, or I can look it up when we're answering questions at the end. I can also do that. Okay, I'm liking all the questions. Keep them coming. It's great stuff. Okay, so the online application process. If you have never used MyLoggers before, it is your single best tool to get access about your benefits. So Shannon, if you want to get access about your benefit specifically, this is another place to go. Instead of going to our public site, you can actually go to your account and it will tell you everything you need to know about your benefit. So if you've never used the system before, or it's been a couple years since you have, you'll need to click enroll now. Okay, so you click enroll now. It's going to answer some simple questions about yourself, like last 4 your social, date of birth, things like that, to verify that you are who you say you are. And then you'll need to set up a password, security questions, all the things you've done with a secure login in the past, for online banking and things like that. Similar sort of process. And then you're logged in. And within the system, you can generate benefit estimates and save up to 10 of them on the system so you can access them at any time. You can apply for your benefit, you can update your beneficiaries, update your contact information. And it's just a really great resource for you. And you can also look at your benefit elections that your subdivision has. Okay. So all a great resource for you to strongly consider, because it's the best tool that you have about your benefit, because it's custom to you. It's about your benefit, not necessarily my city has this with, kind of more generality, which is what the seminar has been. This gets more specific and custom to you. Okay. So what to expect after you apply. So if you apply online, you're going to get a confirmation email because you have to have a valid email address to have a MyLoggers account. But if you apply using the paper form, there is a field where we ask for an email address. 2 suggestions there. Well, 3. If you don't give us an email address, you're not going to get the confirmation email, obviously. Okay. But if you give us an email address, we would suggest that you give us a personal email address. It's not because we're going to hit you with a whole bunch of email. It's because this is your point of contact through this process. So that way, if you give us your work email address, but you decided to use your last 3 weeks of vacation as your last 3 weeks, and you're out and you're not checking those emails, well, that correspondence may not reach you, right? So make sure you provide us with an email address. And if you don't, and if you do provide us with an email address, ensure that it is a personal email address. Okay. So once we receive your application, you'll receive the packet, is what we call it. It's the election of payment form, 2 to 3 weeks before the first of a month that you're going to get paid. Okay, that's what an effective date is. It's a first of a month. So 2 to 3 weeks before that effective date is when you're going to get that packet. That's if you give us the minimum amount of time to prepare the packet. So if you apply exactly 30 days before the first of a month, then 2 to 3 weeks. If you give us a little bit more notice, like 45 to 90 days, You're probably going to get that packet more in the realm of like 4 weeks before that first of a month. So you get a little bit more time to make that decision for your payment option and things like that. Okay. In the packet, so you're going to receive that election and payment form, but you'll also receive additional tax information, tax withholding forms, and a direct deposit form, all of which will need to be completed and sent back to loggers. Okay. So that takes us to understanding the estimates. Let me get out one of my handy dandy annotation tools so you can kind of follow along with me a little, because this is a whole bunch of very small text on the screen. So what's on the screen is an example of a benefit estimate. You should have received one via email from us prior to the event. Now, if you registered like yesterday, there's a chance it might be still in the queue and you might get it here in a few days. But if you registered well in advance, you should have received one last week, this week sometime is when you're going to get these. But let's go through these really quickly. If you were to generate an estimate from MyLoggers, they would look identical to this. The ones you get internal and the ones you get on MyLoggers look exactly the same. Okay, so top section, that is your loggers number, the employer name, the benefit program that your employer has, the department you're retiring from, and the type of benefit you're applying for. Age and service simply means normal retirement or rule of 80. That's what that means. Okay. Member data. This is all information about you that we have on file, like your date of birth, your service credit, your hire date, date of termination, those sorts of things, all there. More as an FYI for you to take a look at, make sure that it's accurate. If it's not accurate, especially the hire date or the date of birth, that needs to be corrected, obviously, before you retire. So if the hire date's incorrect, the avenue to take care of that is to go to your employer. And as long as you have fact or proof, like W-4s, W-2s, not W-4s. If you have your tax documents that proven your employment was, then you could go back and say, hey, this is when I actually started, and then they can make a correction on their end. But then if there's a change to your date of birth, just so you know, that's why we ask for the birth certificate, because we correct it at that time if there is an error. But if you'd like to do it in advance, we're more than willing to update that. You'll just have to send us a photocopy of that birth certificate to get it changed. But you'll need to call us to make sure. Okay. Member account balance. If you have made any purchases of service, or if you have contributed 2, 4, or 6%, that was a mandatory contribution out of your paycheck through your employment, the funds that you have paid to loggers are listed here. Okay. So contributions, those are after-tax contributions. Interest is taxable. Total account balance is the total guaranteed amount. Why that's important is a member is guaranteed to receive a minimum. A member or their beneficiaries are guaranteed to receive a minimum of what the member paid in. Okay, at a minimum. And we'll get into that when we get into the payment options. Okay, beneficiary data. This is the information we collect at registration. We don't pull your files for this. When you retire, we will pull your files, and we will also utilize the marriage certificate or whatever and birth certificate information that you send us. But for an estimate, we don't pull the files because folks don't update the beneficiaries. And we used to be generating these and we'd have ex-spouses on it. And then you can kind of imagine how that likely went. So we just ask for it at registration and we just utilize that information. If the information was incorrect on registration, it's likely going to be incorrect on the estimate. So if it is incorrect and you'd like an adjusted estimate, let us know. We can fix that. Okay. Salary data. This is the salary information that we're using to calculate out this benefit. If there's 3 lines at the bottom of your page, you have a 3-year average. There's 5 lines, you have a 5-year average salary. Okay. There's always going to be a few months delayed because of our reporting process. Like for example, it's November 3rd. We just had our cutoff procedure that basically allows for the wages to be reported for the month of October, and it's due by the 12th of November. So we're always a month in the rear, and then posting and certifying, it just takes us a minute. Or the system, it just takes it a minute to get it all updated. So usually you've got a few years in the lag, or not years, a few months in the lag there on your salary data. But most of you probably didn't even look at that information and you flipped straight to the page that's on the right of the screen here. You went straight to the payment options. So those payment options are the So you have basically two sections to your payment options. It's under this computed monthly benefit amount. You have this box, which is all of the payment options available to you, not including the partial lump sum. And you have this other subsection box that has all of the options available to you with the partial lump sum factored into it, and the partial lump sum calculated right next to my right arrow in that gray box, or in that blue, and right next to that blue arrow in that gray box. Okay. And then down here at the bottom, in that section, there are it's comments or a notes section. And basically what that's doing is it's disclosing what actual percentages that we used for calculating out these payment options, because there are adjustments for age differences and age in the terms of the partial lump sum. So on option A and B, that's your joint survivor options, there is some age adjustment. You'll receive a lesser portion if your spouse is younger, a larger portion if your spouse is older, for both of those options. And then for the partial lump sum, there's a reduction for being older than the age of 60 versus younger than the age of 60. We'll talk about those in more detail here in a minute. All right, let me delete my annotations here and move on to the next slide. Okay, so you have a whole bunch of different options that are available to you to choose from. If you're a married individual, it's all of these options. If you're single, you don't have the ability to do A and B unless you have a different type of joint survivor, which I'll explain that definition here in a minute. But life A, B, C, and the partial lump sum can be added to all of the payment options. The big thing that we always talk about here is when you make the choice of a partial or of a payment option, it is irrevocable. So you make the choice and you can't change it in the future. Once you receive that first payment, you are locked into the option that you have chosen until you pass away. Okay, so that's why it's really important that you attend a seminar and get educated on this information. So we'll talk about each one of these in detail. But number one is they're irrevocable, can't change them. Number two, the other question that I always tend to get when we start talking about payment options is, what's the best option? And there isn't one that's the best. They're all actually designed to divide up the value of your benefit to either you or multiple lifetimes or through a lump sum. They're all kind of designed to just take that value of your benefit and split it out in different ways or pay it to you directly, and only you. So, there's that's the, well, what's the best option? And then the follow up to that every time, and when I tell them there's not really one that's the best, they're all kind of designed to pay you the same dollars. It's just who gets it when type thing. Then the follow-up question seems to be, not all the time, but a lot of the time tends to be, well, I know you can't tell me that what the most what the best option is, because there isn't one, but what's the most popular option? And that also isn't necessarily relevant. So the big thing that you need to be thinking about when you're choosing a payment option is your lifestyle, your financial needs in retirement. So are you going to pursue a hobby? Are you going to travel? Do you want to leave a legacy? Like all things like that. Do you want to provide for your spouse once you're gone? Those are questions you need to be asking yourself when making this decision. Not what did Joe, my neighbor, do, but what best fits my financial scenario. Okay. And we'll break out of getting out of the details here in a minute. And I'll kind of give you an example of how to get into that headspace. Okay. But first, let's talk about a few of the options in a bit more detail. The life option, also called the life allowance, what it does is it pays you the highest monthly benefit you can receive from loggers, with no reductions, but then upon your death, monthly payments stop. So, so the monthly payments will stop upon your death, but it's your full unreduced benefit. So if we use that example that we used on the second slide from the presentation way back when, take 1.5% times the $3,000 average salary times 25 years of service. That gives you $1,125. It's payable to you each and every month for the remainder of your life. Then when you pass away, those monthly payments stop under the life option, under the life allowance. Okay. The eligible beneficiary under the life option is any person, trust, charity, or other legal entity. And you're like, wait, Jeff, you just told me that they don't get anything. Well, they might. Okay. When a beneficiary will potentially receive something from the life option is if you had any contributions in the system. So if you made a purchase of service, or if you were required to contribute 2, 4, or 6% of your salary into the system, well, those are, like I said, those are guaranteed funds. So you're guaranteed to receive a minimum of those contributions back. And you're guaranteed to receive it, or your beneficiary is guaranteed to receive it. I'll show an example of this on the next slide. But the beneficiary will receive any remaining contributions. So if you had any contribution balance and there's some remaining after you retire, and after you have passed away, then in that case, that beneficiary will receive whatever's remaining of your employee contributions. Okay. If the beneficiary predeceases you, this beneficiary can be changed at any time throughout retirement. Okay. So let me give you an example of when a beneficiary would receive a payment under the life option. Okay. And it's one payment, not multiple. It's just one payment. So if you're receiving $1,125 per month for their lifetime, at the time of retirement, they retired with $25,000 in a $25,000 member contribution balance. Okay. Member passes away after 18 months. Okay. So we take the $1,125 times 18. That's $20,250 that we paid out to that member, not $25,000. Okay. So what we're going to do is we're going to take whatever that contribution balance is. We're going to subtract out the total distributions, and we're going to pay that beneficiary a one-time payment of $4,750. Okay. This individual would have lived 5 more months and then passed away. The beneficiary would have received nothing, because they would have received more than that 4,750 over those 5 months. And they would have received probably like 26,000 something, 25,000 even, somewhere in there. And there wouldn't have been a contribution balance left, because member contributions for loggers purposes are paid out first. So if you got $25,000 in member contributions, the first $25,000 you receive in monthly payments is your member contributions. Okay. And everything after that is employer assets. Okay. Any questions thus far? Again, how are you going to ask them? Type them into the Q&A, or raise your hand to be able to ask your question to me via the chat, the audio chat. So just feel free to do that, or either way. So now let's move into option A. Option A is the first of 2 joint survivor options we're going to talk about today. What it does is it pays you a reduced benefit for life. And then when you pass away, your beneficiary is eligible to receive a portion of the monthly benefit that you're receiving at the time of your death. Okay. So what option A does is the member receives 85% of their benefit. So if it's that same $1,125 life allowance amount, then 85% of that is $956.25. That's what the member receives for the remainder of his or her life. And then when the member passes away, the beneficiary is then eligible to receive 75% of the monthly benefit that the member was receiving. If that number is the same, which more than likely it's not, because we have cost of living adjustments that are built in. But if it's the same, then we take that $956.25. The beneficiary gets 75% of that amount, which comes out in this case to $717.19. And the beneficiary receives that amount for the remainder of his or her life. When both the member and the beneficiary have passed away, there is nothing else payable unless employee contributions remain in the system. And then the mechanism that I talked about with the life allowance would apply there. Okay. This also assumes that the age difference assumes that the member and the beneficiary are exactly the same age. So if you're, again, remember how I told you in the bottom of your estimate, there's a comment section that has the option A factor and option B factor. So the option A factor, if it's, 0.085 or 00, I can't remember what exactly it is, but if it's 85%, if that's the factor that's used there, then you're either close, there's a rounding mechanism, but you're either close enough to the same age, or you are the same age. And then it's 85, 75. And then if your spouse is older than you, you're going to receive less than 85%. If your spouse is younger than, sorry, I got that backwards. If your spouse is younger than you, then your factor will be less than 85%. If your spouse is older than you, then your factor will be more than 85%. Okay. And that's because we're paying for multiple lifetimes. So when the person's younger than you, we're expected to pay a payment for a longer period of time. Eligible beneficiary on option A. Okay, so option A, the beneficiary definition gets a little bit more restrictive, and also on option B. The rules and the way they operate for option A and option B are identical. It's just the dollar amounts are different. Okay, so the eligible beneficiary for the option A and option B is a spouse of at least 2 years, or another adult who's 40 or older, who's been more than half financially dependent upon you for at least 2 years. So if you aren't married, but you have an individual that the two of you have been financially dependent on one another for at least 2 years, and they're above the age of 40, then you can list them as an eligible beneficiary on option A and option B. Otherwise, it's a spouse of at least 2 years. Okay. The beneficiary will receive 75% of the member's monthly payment, okay, for life. This is not including any temporary benefits. Okay, so if you have an LT plan, if you don't know if you have an LT plan, when you're looking at your estimate, it will tell you if you have an LT plan right on that first page in that top section. But also, if you're looking at your estimate with the dollar amounts in front of it, you'll have 3 columns instead of 2. Okay, you'll have a 2 62 or 65, at age 62 or 65, and a 2 potential beneficiaries. You'll have 3 columns. The additional benefit that's payable on an LT plan. Okay, so those of you that have an LT plan, there's an additional benefit paid to you from retirement age until either 62 or 65, whichever your program dictates. Okay, that additional benefit is not payable to the beneficiary. The only thing that's payable is the base benefit. So a portion of that base benefit is what's payable to the beneficiary. Okay, and if the beneficiary predeceases you on option A and option B, the beneficiary cannot be changed. Okay, so the payment option can't be changed. And in the case of option A or option B, the beneficiary cannot be changed. However, if a predeceasement occurs, what will happen is you have to notify us of the death. Okay, so we have to be notified. So upon notification, we will enact what's called the pop-up provision. What this pop-up provision does is for those that retired after September of 1995, I think, or 98, somewhere in there, in the 90s, September of the 90s. But those of you that are on here, it likely applies to. But what happens is with the pop-up provision is you will, upon notification, your benefit will be popped back up to the full life allowance, and it'll remove the reductions for the payment option, and then you'll continue to receive that for the remainder of your life. Okay. So that's the pop-up provision. It's option A in the rules. So that's pretty much it with option A. Any questions, please type them in. We'll move on to option B at this point. So option B, what it does is it operates the same way as option A. In fact, the illustrations are going to look very, very similar. The difference is the dollar amounts. So the portions of the benefit that you're eligible to receive and your beneficiary are eligible to receive are different on option A than they are on option B. Okay, so option B pays a monthly lifetime benefit to you. Then upon your death, it pays an additional lifetime benefit, which is a portion of what you were receiving. But the difference is, again, the amounts. So on option B, take that same life allowance of $1125, and instead of getting 85% of the benefit under option B, you get 90% instead of 85 like with option A. Okay, that comes out to $1,012.50. Then upon your death, the beneficiary, instead of getting 75% like with option A, gets 50%. So we take that $1,012.50 times 50%, and that comes out to $506.25 in this example. So which option, A or B, which one's right or wrong? I mean, that's really for you to determine. We can't counsel you or advise you on which one you should or shouldn't choose. But I can kind of help you with getting into the headspace. So like, for example, my financial situation. I have a pension with Loggers. My wife has a pension because she's a public school teacher. And so her necessity for my pension income, she probably still has a necessity for it, but it's less than if she didn't have it at all. Like if she didn't have a pension at all, then option A is likely my option. Or if she didn't have an employer-sponsored retirement plan that she was utilizing of some kind, then she might need more funds from me upon my death. But what option B does is it also plays well into my wife and I's plans in retirement. Our plans are, when we decide to leave the workforce, is we're going to road trip the country. We're going to go get an RV, or maybe get one beforehand so we can afford to pay for it. But we're going to hopefully get an RV. We're going to travel to all the national parks. We've been to several, but there's several that we'd like to get to that I don't know if we'll ever get to until we're retired, because it just the amount of time it takes to get to them. And taking off that amount of work is a little challenging. So that's our plan. And while we're doing it, we're also going to visit baseball parks, because we like the history of baseball. We just like the game. We're just fans of the game itself. And we're also fans of all the really cool ballparks that are out there. So we want to go see a bunch of them. And so that's our plans. And that plan, while we're both alive, is a tad bit more expensive. Yeah. So what, in that case, you're thinking, well, if it's more expensive when we're both alive. Our lifestyle once I'm gone, my wife's lifestyle once I'm gone might not be as expensive, because I mean, she might still travel the country by herself. I don't know, but I don't think that's her intent, because that plan is for us. So then she can sell the RV and move back to the homestead and live on her pension income and the smaller amount of pension income from me that still helps sustain her and pay the bills. But by having option B, it gives us more money when we're both alive, when our lifestyle is more expensive. So not saying that's your option, because your option needs to best fit your financial scenario. I'm just telling you, that's how I get into the headspace of like, what plans am I going to do? Are we going to travel? Are we not going to travel? Does my wife really need this income once I'm gone? Could she live on less than that? And all those things. And it's not a matter of like, I don't want to financially support my wife, right? It's more of, I think that she'll be okay with a little less so that we can do the things that we want to do when we're both retired and still alive. Food for thought, more than anything. So the rules for option B, again, are the same as option A. So the eligible beneficiary, spouse of at least 2 years, or a 40-year-old adult who's more than half financially dependent on you for at least 2 years. The beneficiary gets 50% of the member's monthly payment. Again, it doesn't include the temporary benefits if you have an LT plan. And if the beneficiary predeceases, there's no changing the beneficiary, but it may enact the pop-up provision. So when we say pop-up provision, the other thing to make very, very clear here is the pop-up provision under Logger statutes specifically says predeceasement. It says nothing about divorce. So if you were to choose option A or option B, and you're married at the time, and then you get a divorce, and you named your spouse, who's now your ex-spouse, on these payment options, upon your death, that ex will will receive your payment. And there's no way to remove them from that. So just to be abundantly clear about that, it's predeceasement is what applies for the pop-up provision, not divorce. Okay. All right, option C. Haven't seen any questions come in, so I know you might have a few. Type them in, get them in. So if you're going to type them in, type them into Q&A. As I showed you before, when you type them in, I will answer them. I see them as they come in, then I'll open it up and I'll answer any questions that you have. So at this point, we've covered the life option, which is the option that pays you and only you. We've covered option A and option B, which are our joint survivor options. Moving into option C, if you're looking at your estimate, says life with 10 years certain, something like that. Okay. And to me, that sounds a little misleading because you might accidentally interpret that as you only get payments for 10 years. So let me clear that up. Any option you choose, whatever option it may be, the member receives payments for life. But what option C does is it adds a guarantee. It guarantees that we are going to pay a minimum of 120 payments. And that 120 payments is paid to either you or a beneficiary, but it's a minimum of 120, not a maximum. Okay. And your beneficiary, as you can see on the screen, will receive the same exact dollar amount that you were receiving upon your death, but it's for a limited amount of time. Okay. So let me illustrate. If it lets me here. There we go. So remember, so in this is an example. We do have a minimal reduction for the guarantee, and that's a 5% reduction to benefit. So that comes out in this example, it's $1,068.75. And here's just a quick illustration of how this benefit option would actually work and pay a beneficiary. Okay. So if you were to retire January 1st of 2010, you begin receiving $1,068.75. You pass away on January 1st of 2017. We paid you 7 years or 84 payments of $1,068.75. Option C guarantees a minimum of 120 payments or 10 years worth of payments. Okay. So what happens is at the time of your death, the beneficiary then begins receiving the remaining payments. In this example, it's 3 years. So 36 months worth of $1,068.75. Then once we've paid a total of 120 payments, then the benefits stop to the beneficiary. Okay. But if you were to live, say, 12 years, so you live 144 months into retirement, then what option C would do in that case is we're going to continue paying you a monthly benefit for all 12 years. But then when you pass away, because we paid more than 120 payments, your beneficiary would receive nothing. Okay. So this is just another flexible option for you, especially for those of you that aren't married. Okay, so option C, on option C, the beneficiary can be any person, trust, charity, or other legal entity. Okay, so pretty much anyone except for your dog. So any person, trust, charity, or other legal entity can be listed as a beneficiary. If 120 payments worth of the member's benefit have not been made upon your death, then the beneficiary receives the remaining payments. And a very unique component of this option is it's the only option that pays a monthly benefit to a beneficiary where the beneficiary can be changed at any time during retirement. So there's no pop-up provision for option C. What happens is if you have a beneficiary and they predecease you, you will elect a new beneficiary in that case. You can also have multiple beneficiaries. You can have multiple primaries, multiple contingents. You can kind of set it up however you want. If you have really complex beneficiaries and your estate's a little complex, I would suggest maybe talking to a certified financial planner or even an estate planning attorney, just to make sure that things settle the way that you want them to settle after you have passed away. Because that's one of the things that a lot of elderly folks think they're doing good enough in, and they typically don't. And that's also where the opportunity for elder abuse occurs. So I would strongly suggest if you have several beneficiaries or not, if you only have a couple, but you just want to make sure that things go the way that you want to go talk to a certified financial planner who has part of their education and certification requires them to be knowledgeable about estate planning. And then the other side of that is an estate planning attorney, or those are typically the folks that write the trusts, but they can also help you ensure that your funds, your money, and your final affairs are handled the way that you want them handled. Okay. All right. So that's it on the payment options. Haven't seen any questions. I mean, let me put it this way. That's it on the primary payment options. The partial lump sum is obviously a payment option, but it can be added to all of the things we just talked about. It can be added to the life option, A, B, or C. So it kind of throws a wrench in the mix and gets a little complicated. Okay. But that's it on the primary ones. So again, life pays you and only you. The only time a beneficiary receives something is if there's member contributions remaining. Option A and option B, you take a reduced benefit, so a joint survivor can receive a portion of what you were receiving upon your death. Option C guarantees a minimum of 120 payments paid to you or a beneficiary. Okay. Now, partial lump sum. Partial lump sum, again, can be added to all of the different options. It's equal to 24 payments of your life allowance. So if your life allowance was $1,000 a month, take that times 24. That's going to give you $24,000 in a partial lump sum benefit. Doesn't include the temporary benefit under the LT plan. So if you have an LT plan and you're looking at your estimate, you're going to take the at age 62 or 65, whichever your program dictates. Okay. You're going to take that number times 24, and that's going to be your life allowance. It's not going to include that temporary component. It's payable 90 days after retirement, unless you tell us to delay it further. And you would want to delay it further, potentially to put it into a different tax year, right? So you could take So if we delay it further, we could pay it to you in a different tax year and potentially have less of a tax burden for you. But before you make that decision, you should definitely seek some tax advice from a trusted tax advisor. But payable 90 days, not day one. Okay, we're not going to pay it on day one, and that has a lot to do with some of the reporting procedures and a few of the other things that we work through and do that have a little bit of a delay. So like I told you earlier, we're kind of usually a month in the rear when it comes to wage reporting. So if you can envision that, you apply for a benefit on January 1st. We're receiving wage reports that you worked likely in December on January 12th, but we paid you a benefit on January 1st. Then if that wage report has has an impact on the monthly benefit and service credit and salary component, then we will adjust and recalculate your recalculate your monthly benefit, and we'll adjust that monthly benefit as needed. That's a little bit easier adjustment because we're talking about one monthly payment that we just need to catch you up on. Whereas a partial lump sum, we're talking about multiple monthly payments added together into one payment. And if we overpay or underpay on that, that's a little bit more dicey because we're not talking about 10, 15, 20 bucks. We might be talking about a few hundred, $1,000. So we got to make sure it's right. So our processes take us about 90 days to get that done because of the wage reporting and a potential recertification from your subdivision and then a payment process. So it just takes us a little bit of time to get it done, but 90 is when we'll pay it. You'll get a benefit. Your monthly benefit will start on that effective date, but your partial lump sum will be paid 90 days after that. Your monthly benefit will be reduced by 16% if you're taking that benefit at the age of 60. If you take it at an age older than 60, it will be reduced by more than 16%. If you're younger than 60, it will be reduced by less than 16%. Okay. So in other words, if you are 61, your reduction will be 16.4%. 62, it's 16.8. If you're 59, it's 15.6. So it's 0.4% more or less, older or younger. So more for older, less for younger, but 0.4% additional adjustment for your age. Okay. That adjustment is already included in your benefit estimate. So if you are old, if you're planning to retire at 62, 63, 64, whatever, if you're planning to do that, that adjustment has already been included in your monthly benefit and in the calculation of the partial lump sum. Okay. So just keep that in mind. There is that adjustment for being older than the age of 60 or younger than the age of 60. And that may sound backwards. So let me kind of explain to you why it's like that. So the reason the reduction increases the older that you are is because the partial lump sum by design is a loan. We're loaning you money 90 days after retirement based on a benefit you're going to receive for a estimated number of years in the future. Okay. And let's say that estimated number of years for a 60-year-old individual is, say, 25. I don't know exactly what it is. It's somewhere in that ballpark, depending on your gender, and also depending on the type of work that you did, if you're public safety or general. But let's just say it's 25 for our example. It makes it easier. Okay. So 60 to 25, that's 25 years. So anybody who's ever taken out a loan before or a mortgage understands that the longer the term of a mortgage or loan, the lower the payment. The shorter the term, the higher the payment, right? So from 60 to 85 in this example, at 25 years, that's a 25-year term on the loan. If you retire at age 65, even though you worked an extra 5 years, we still expect you to pass away at the age of 85. That's the expected ballpark of where we're expecting that to happen. So because of that, that's a shorter term. Shorter term results in a larger payment, therefore a larger reduction. Okay, that's by design what the partial lump sum is it's a loan. We're paying you a chunk of your benefit early in retirement, and we're loaning it to you by reducing your monthly benefit going forward. Okay. So a couple things, and we talked about this generally earlier when Michael asked the question about why can't we split the distribution up? So there's two options of what you can do with the distribution. You may take the distribution directly. If you're taking it directly, we're cutting you a check and we're sending it directly to you. Okay. So we're cutting you a check and we send it directly to you. If we cut you the check and send it directly to you, the IRS instructs us that we must withhold 20% and forward it to the IRS. That's just for the feds. It's also not necessarily what you owe. 20% is just the round number that they apply to the entire population. What you owe will be dependent on your tax rate, not necessarily this 20%. In addition, it does not include any state income tax, which may also be part of the equation for you, okay? So keep that in mind. If we take it directly to taxable movement, we're going to take 20% off the top, forward it to the IRS because the IRS code tells us we must. And we're not going to be including any state income taxes. In addition, general employees younger than 55 or public safety employees younger than 50 taking this distribution will also be potentially subject to an early distribution penalty of 10%. That's if they receive the payment directly. And that 10% will not be assessed on the payment. It'll be assessed on April 15th when you pay your taxes, okay? Or file your taxes and maybe pay more or less, okay? The other option of what you could do with this distribution is do a rollover. So this is kind of what Michael was talking about with why can't I receive one payment for one and roll over the other? And that has a lot to do with the IRS code and the type of distribution that it is, because this payment option is kind of set in stone of like, this is the amount that it is. And the IRS code dictates that they either have to roll it all over or they have to take it directly and be taxed. If they take it directly, use a portion of it and then try to do a rollover, that's called an indirect rollover. And the IRS code dictates that in an indirect rollover, it has to be the exact amount that was paid from the payment. So it gets messy. So if you do a rollover, this is what it is. Rollover, what they call it, is a trustee to trustee transfer. So it's a transfer from one qualified plan, loggers, to another qualified plan, whether that's your IRA at your bank, your 457 or your 401k plan. You roll those funds in, you transfer it from loggers to this other plan. By transferring the funds from one plan to another and you don't receive payment, that's a non-taxable movement of money. So by doing so, we're not withholding the 20%. You may or may not be subject to a 10% early distribution penalty. All depends on when you withdraw the funds from that 457 plan or the IRA plan. But when you do it, we're going to roll the entire amount, not net 20%. And if you're trying to do I only need part of it, once you roll it over, then you withdraw what you need from that qualified plan, pay the taxes on the amount that you need, and leave the rest in the plan so that you pay taxes on it when you withdraw it later on. Okay. So that's kind of your choices there with the partial lump sum. Quick, I'm going to get a sip of water here. So a quick just an illustration of the partial lump sum. So this is the life plus. So it's the life option with the partial lump sum added to it, assuming you're age 60 at retirement. Okay, so we take $1,125 times 84%. That's at 16% reduction. So your monthly payment's $945 a month. And your partial lump sum, we take $1,125 times 24. That gives us a $27,000 partial lump sum. And you're still receiving $945 per month for the remainder of your life. Okay. That's just a quick example of how the math works from the monthly benefit perspective. So that's all of it for the payment options. Okay. So we've talked about the life option, A, B, and C, and the partial lump sum. Keep in mind the partial lump sum can be added to all of the primary payment options. Again, life pays you and only you. Option A and B, joint survivors, reduce your benefits so that the beneficiary can receive a portion of what you're receiving. Option C is the guarantee of a minimum of 120 payments. Partial lump sum pays 2 years worth of payments 90 days after retirement and can be added to all of those options. So if you have any questions, again, type them in. We're going to keep moving forward. But if you do have a question that's about something we talked about earlier, I'm happy to stop what I'm talking about and answer any question that you have. So please feel free to type those in. Okay. So employment after retirement, how are we doing on time? We're actually doing pretty good. We've moved rather quickly. That has a lot to do with no questions, but that's okay. So if you're just absorbing and don't feel like asking questions, no problem. We'll just keep on moving. But again, if you have them, type them in. I'm happy to answer any question. Okay, employment after retirement. So when I say employment after retirement, this should probably say more like employment after drawing your logger's benefit, because my definition of retirement means that there is no such thing as employment in my life, right? So so it's more like working after drawing a logger's benefit. Like, what options do you have? So you have three primary options. The first you can continue to return to work and continue to receive your full loggers benefit if you return to a non-loggers employer. This can be private sector or public sector, doesn't matter. You can work there as much as you want, make as much as you want, much as you can. And there's not going to be any sort of limits there because we don't know about the employment because they're not covered by loggers. And you will continue to receive your monthly benefit in that case. You can employ part-time with any loggers employer. That includes the employer from which you are about to draw a benefit. You can return there on a part-time basis. Now, loggers doesn't define full-time and part-time. The statutes that govern us don't necessarily define that. What is defined is a covered employee and an uncovered employee. So a covered employee is an employee that works above their subdivision's annual hours required for coverage. Okay. This is an election that your subdivision made when it joined our system. It can be 1,500, 1,250, or 1,000. Most employers, nearly 90+%, it's 1,500. So any position requiring 1,500 hours or more is a mandatory covered position. Any position working less than that is uncovered. And that's what we're talking about when we talk about part-time. Okay. So if you're going to do a part-time gig, make sure you're working below your employer's annual hours required for coverage. Your employer will assist you with this as well. It'd like to help you manage your hours. But just make sure you maintain below that. Okay. You can work part-time with any loggers employer, including the one you're drawing a benefit from. You can also re-employ full-time with a different loggers employer. So loggers has 842 subdivisions across Missouri, all of which have their own contribution rate, their own trust. Basically, it's like we're a whole bunch of small pension plans managed under one big roof. So that's what allows you to go from one employer to the other and not have an impact to your benefit because you're going essentially from one pension plan managed by loggers to another pension plan, right? So you can reemploy full-time with a different loggers employer. The requirement is you must have a 1 calendar month break in employment. And that's from your 1 calendar month break in employment from benefit effective date or termination date, whichever is later. So about a calendar month break. Then after that calendar month break, when you could return to loggers covered employment at a different employer, you'll begin accruing an additional separate loggers benefit. Everything is separate: salary, benefit calculation, all of it. So it's all separate. You would be vested after 12 consecutive months of employment at the new employer. And then when you're ready to retire a second time, you'll go through the same process that you're going through now, where you'll apply, select a payment option, and then we'll add it to your deposit. You can do that as many times as you want as well. There's no limit. I've been with loggers. My 13th anniversary is coming up here in March. And I've seen the same person at a pre-retirement seminar in my career 3 different occasions. First, they were retiring under Rule of 80. Then they went and reemployed with a different loggers employer, and they were retiring at 60 from that one. And then they went and reemployed, and they were retiring at 65 from the next one. And during all that time, they were employed with different loggers employers. It's a significant benefit to some of those smaller employers in our state that maybe you work for a larger employer and you can bring some of that institutional knowledge to that smaller employer, and you can justify having a lower salary because you have your pension benefits that are going to offset that. So definitely something to be thinking about. Of course, your fourth option is actually to just retire and don't reemploy, right? But that may not be an option for you. So that's the working after drawing a benefit. Now let's talk about taxes and exemptions. So first and foremost, loggers staff, we can give you some general guidelines of like how you need to fill out your form, but not tell you what amounts you need to put in the forms, not tell you how you should withhold your taxes. That's not something we can provide. That's called tax advice, and we can't do that. So if you need tax advice, I would suggest before pulling the trigger on retiring is to talk to a trusted tax advisor. And you may be like, I'm my own tax advisor, I file my own taxes. That's great, but it might be a good idea to sit down with a CPA, pay them for their time, of course, but sit down with them and say, here's all my sources of income. What would be your best suggestion for withholding on my loggers benefit, on my 457 benefit, on my Social Security, whatever it is, all your different sources, so that you're not caught with a curveball when it comes to April 15th, because you don't want a curveball on April 15th. So that's my 2 cents is definitely think about talking to a trusted tax advisor before pulling the trigger, and then maybe throughout retirement as well, just to kind of make sure that you're withholding properly and that you don't have any unexpected tax expenses when it comes to tax time. So first and foremost, your benefit will be subject to both state and federal income tax. Okay, so when you retire, you'll complete a withholding form similar to the way you complete a withholding form now for employment. 1099-Rs are mailed in January of every year. The due date, the federal due date, is January 31st. That is the date we shoot for. Most of the time we're done a little earlier than that, but the due date is January 31st. So that's when they're mailed. The IRS code requires a post date of January 31st. So we may mail them sooner than that if they're done sooner than that. But as our system grows and as our retiree population is growing a little bit because of the baby boomers retiring, the turnaround is a little bit longer, but usually we're done before the 31st, but just keep in mind the due date is the 31st. If you take a partial lump sum, you'll receive a separate 1099-R for that distribution, and that's because you can do a rollover with it or you can take it directly. Okay, so the IRS kind of dictates that since it's a lump sum payment and not what they call an annuity payment, that it needs to be on a separate 1099-R for that purpose. If you're planning to move out of state, make sure you remove state withholding. So you don't want to be living in a state that maybe doesn't have income tax, or maybe does, but you don't want to be living in another state while paying Missouri state income taxes. You want to be paying the income taxes that state may or may not have. Okay, so make sure that if you move out of state that you let us know so we can remove state withholding. Key there, as I said, remove state withholding, not update. We can only withhold for the state of Missouri. We can't withhold for any other state. Okay. In the state of Missouri's income tax or revenue taxation code, there's a couple of things to be aware of. The first is the Missouri Public Pension Exemption. So, so this is under Chapter 10 of the Taxation and Revenue Tax Code, Section 143.124. Why that's important is if your accountant doesn't know about this, they need to reference that statute so that they can understand how it works. But the exemption is up to 100% of your public pension benefits. Logos is a public pension plan. And the exemption is limited to the maximum Social Security benefit for each spouse, which I think is around $40,000 right now. Okay. So 100% of your public pension benefits may be tax exempt in the state of Missouri, limited to the maximum Social Security benefit for each spouse, which is around $48,000, if you meet the eligibility requirements. The eligibility requirements are married couples with an adjusted gross income of less than $100,000, single individuals with an adjusted gross income of less than $85,000. If you meet one of those eligibility requirements, then 100% of your public pension benefits will be tax exempt for state of Missouri income tax purposes, limited to the maximum Social Security amount for each spouse. If you are in excess of those adjusted gross income eligibility requirements, then you may be eligible for a partial exemption. That's where a CPA can come in handy. They can do those calculations for you. In addition, if you qualify for a lower earner Social Security or Social Security disability deduction, the exemption amount must be reduced by the deduction amount. So just ballparking here, this is not a real example, but if the deduction for your Social Security disability deduction is $5,000, then the maximum exemption in that case, instead of being $40,000, would need to be reduced by the 5, which would be $35,000. Okay, there's a lot there. I just threw a lot at you. Two things, primary things to remember. One, if you are receiving public pension income, there's a chance that, and there's a likelihood even, especially in local government work, that you're likely going to have some, if not all, of your pension benefits may be exempt from Missouri state income taxes, not federal. But you have to meet the eligibility requirements. In addition, if you receive more than the maximum Social Security amount for each spouse, everything in excess of that amount is fully taxable for the state of Missouri. So an example of how that can really come back to bite you, because you could hear me telling you public pension exemption, and you're thinking, great, I don't need to withhold for the state of Missouri. And that may or may not be your approach. You need to talk to your accountant about that. But let me give you an example of someone that went to that approach, and they got a curveball on April 15th. Okay. So this person took a partial lump sum directly. Partial lump sum is fully taxable. So the fully taxable benefit, we're going to say that partial lump sum was $70,000. Okay. That's not what the amount was, and the exemption amounts were different then, but we're just going to say it for this example that it was 70,000. And I took, and they began drawing their benefit on January 1st. Okay. So they're going to have 12 monthly payments in a tax year plus a partial lump sum. Okay. That partial lump sum was, say, 70,000. The maximum exemption amount per each spouse is 40,000 in that example. So they already have 30,000 that's going to be taxable for the state of Missouri income tax purposes, plus every single monthly payment they receive in that year. Okay. And then it comes to April 15th and they got a little bit of a surprise because they didn't think they were going to owe any state income taxes, but they owed a significant amount of state income taxes because they thought they had this exemption that was just fully exempt. And no, there are limitations and there is eligibility requirements. So make sure that you're planning accordingly for those and definitely talking to a tax advisor. Okay. But good news is you're receiving public pension income. So there's a high likelihood that you may have some, if not all of your public pension income exempt for state of Missouri income tax purposes. Public safety retirees. So that's police, fire folks. You may have your health and long-term care premiums withheld from your check. Currently, this is how it works. Now, there has been federal law that's been proposed. I don't know if it's going to pass or not. There's a lot of things that happen on the federal level that, it takes a minute to get things done. So, but this was actually a federal law that was passed and then passed at a state statute level 2 years later that has allowed us to do this. So right now, the way we do it is your health and long-term care premiums can be withheld from your monthly benefit, and then we forward them on to your health and long-term care provider, policy provider. Okay. Up to $3,000 of those premiums may be, well, if you pay $3,000 or more, you may be eligible for a federal income tax deduction of $3,000. You must have been a public safety officer upon retirement and retire under a normal retirement provision, including the Rule of 80. In other words, if you had a disability, you don't qualify for this, but if you retired under any other normal provision, you would qualify for this. What the federal law that's potentially going to change is not going to change the actual deduction. It's just that you're going to qualify for it without having to withhold it from your check and forward it on. So we'll see how that plays out and we'll communicate with the folks. But for now, if you are a public safety retiree and you have health and long-term care premiums that you want to withhold and forward it on to the premium provider so that you can qualify for that deduction, we can definitely administer that for you. Okay. Finally, cost of living adjustments. It's the last slide of the day. I think it might be second to last slide of the day. I think there's one more, but I'd say the last slide with some meat on it. Cost of living adjustments. So this is something that our board takes very, very seriously. And it's something that is very important to our retirees' well-being, and we understand that. So what happens with the Loggers cost of living adjustment is it's designed to keep the pace of inflation. So it's designed to keep up as the cost of goods continue to increase. Now, there are some limitations, but the limitations are not like limitations set you back forever. They're limitations that are going to require us to catch you up over time versus being able to realize things immediately. So let me explain a few things to you on how this process works, and then we'll go from there. So first and foremost, the increases are paid. So benefits are increased effective for October 1st benefit payments. So that's when we increase the payments. Okay. They're based on the Consumer Price Index. We use the CPI-U, which is a measure of inflation. So it's based on that. Now, when it says based, the key there is that this is made at the discretion of the Board of Trustees. Within our governing statutes, this is the Board of Trustees are the ones that say, yes, we can give this, or we're not going to be able to give this, we're going to have to give this, or things like that. And that's all based on the solvency of the plan. And Loggers remains one of the most solvent plans in the country. So over our 55 years of existence, they've been able to give the maximum amount that they've been able to give provided by the law. So that speaks very, very highly of the security of your plan. But just so you know, it is given at the discretion of the board. So it's not a guaranteed thing, but just so you're prepared for that. Not that it's going to happen, but just so you know. But this is how it works. Based on that Consumer Price Index in July, it cannot exceed 4% per year, but the increase is cumulative year to year. So last year is a prime example of where the increases couldn't exceed 4% because inflation was higher than 4%. Okay, so what happens then is all retirees get 4%, and then we owe them whatever the remainder is. This year would have been an extra 5%. So then we owe them that remainder in future increases. Okay, so there's a high likelihood that our retirees for the next year, if not two, that they're going to receive 4% increases. Okay, but we're going to catch them up over time. And the goal there is always to get our folks at 100% purchasing power. And kind of the way that we do that is we base it on whatever fiscal year you retired in. And then there's kind of a base value of the dollar at that time based on the CPIU. And we want to make sure that you're at 100% of what that purchasing power was at the time of retirement. And that's the goal of our increases. It's a little bit different than some. You may have heard just like a blanket 3%. Some of it's like 3% on the base. So it's just the same amount every year. This is a 4% increase on your monthly benefit that you're receiving in that year. So it is compounding and it's cumulative. So it gets really complicated really fast. Okay. One other thing to consider is you must be retired for 12 full months, including in October 1st, to be eligible for your first adjustment. Okay. So if you retire on November 1st, you're going to be waiting 23 months to get your first increase. Now, our increases are cumulative based on that fiscal year that you retired in and the amount of time that you've been retired in order to compensate and catch you up. So it's cumulative. But if you retire on October 1st, your first increase would be 12 months later. November 1st, it's going to be sometime later because you have to have been retired for 12 full months, including on October 1st to receive your first one. So that's kind of a little wrinkle in the mix there. But keep in mind, benefits are cumulative, or the increases are cumulative. We're going to catch you up over time based on the cap and also based on when you actually retired. So just keep that in mind as well. Okay, so one thing here, we have this section about the Retiree Link meetings, but we aren't going to be hosting Retiree Link meetings in 2022. A couple reasons why. Number one is we're trying to find more attendance to these. We've been doing these for about 4 or 5 years. In the first, 3 years or so, we were getting pretty good attendance and active engagement. And since then, we had the pandemic that hit. So then we had to suspend them for a while, and then we started them back up. And since then, we haven't had as good of attendance, and we're trying to figure that out. So this year, we're going to kind of put them on pause and reintroduce them again at some point in the future, and change the way that these are going to be formatted. But I would still expect that it will be an opportunity for you to reconnect with peers from your region. You'll still hear updates from Logger staff. And I would also assume that we maybe, but there might be some educational components as well about retirement related topics. So be on the lookout for those here in the next several months. Okay. If you retire, that is. If you don't retire, well, don't be on the lookout until you retire. Okay. So other ways to stay connected. We have we're available on all the large digital platforms. We have Facebook, LinkedIn, Twitter. We have a Vimeo channel where it has a lot of our recorded webinars and things of that nature there. We also have a blog that we post to semi-regularly, about once every other month or so. But there's a whole lot of great content on that blog about, just general ideas of how your benefit works in a much more higher level, less complex manner. So definitely something to be thinking about. But that's pretty much all I have for today. The only other thing I have to add is I do this at the end of every single seminar that I've done for the last 12 years, because it's really something that I sincerely mean. Every time I meet, interface, talk with our members, I'm amazed by the work that you all do, and tireless work and thankless work for serving your community day in and day out. During the last couple of years with the pandemic and all the uncertainty that was happening at that time, local government really showed up. And it proved to everyone who was listening, we already knew how valuable and how awesome you guys were, but everybody else who saw it really, I think, got an understanding of just how valuable local government and the things that local government does for our communities. So from all of us here at Loggers, my sincerest thanks for all the work that you do to make your communities better, cleaner, and safer places to live. But other than that, if you have any questions, type them in. I'll leave the webinar open for the next couple of minutes. to allow you time to type in those questions. But otherwise, I do appreciate your time coming today. If you have any questions afterwards, please feel free to give us a call, shoot us an email. We're happy to assist you in any way that we can. Well, it appears that most folks are leaving the webinar, so I'm going to go ahead and end it at this point. But again, if you do have questions after today, feel free to call us or email us. We're happy to assist you and help you with any question that you may have. But otherwise, have a great rest of your week.